about that. The market is going up. If the market were going up, I would imagine that fears of inflation were diminishing, but they do not seem to be. The headlines and actually some of the statistics that we've seen coming out are quite surprising on the high side. They're certainly surprising me. So let's talk about why inflation might not be transitory. And I'll cut to the quick and tell you, we do believe that inflation is going to come down dramatically. So we have not changed our point of view, but let's be fair and balanced about this and make sure that we do understand what's going on out there. It was very surprising this week or last week to see the union workers at Deere reject their proposal, reject Deere's proposal for wage increases, which in year one, I think, if I read this correctly, year one, 23%, and thereafter 5% for the duration of this contract. And they rejected it. So that is really interesting to me. So let's talk about why inflation might not be transitory. And I'll cut to the quick and tell you, we do believe that inflation is going to come down dramatically. So we have not changed our point of view, but let's be fair and balanced about this and make sure that we do understand what's going on out there. It was very surprising this week or last week to see the union workers at Deere reject their proposal, reject Deere's proposal for wage increases, which in year one, I think, if I read this correctly, year one, 23%, and thereafter 5% for the duration of this contract. And they rejected it. So that is really interesting. That we haven't seen that kind of wage increase, and I'm talking about the 5%, in a very long time. So we've also seen other entities go on strike. Kellogg, the cereal company, on strike. So very different from, the heavy metal Deere union workers. Hollywood Crews are on strike against the studios. So, the strikes are not a good sign. And the wage increases, if they do go through, are either going to hit margins or are going to move through in the form of price increases unless productivity offsets them. So productivity is output per man hour. And productivity increases are an offset to wage gains. So if wage gains are 5% and productivity is 3%, then we're in a 2% underlying inflation world. If productivity is 4%, then we're in a 1% inflation world. Productivity, we believe, is about to explode. But if it does not, these sorts of wage gains would turn into either inflation problems or margin hits, profit problems. So we're watching this very carefully. We did get a productivity number this week. We're getting all kinds of distortions right now because of the supply chain challenges out there and the after effects of the COVID crisis. So we're not, we've seen both productivity explosions, 11% one quarter, and implosions, down 8% another quarter. So those numbers are not to be trusted. And we've got to try and get at what underlying productivity is. And so we're watching carefully for that. Another price out there that has surprised us is the oil price. I'm on record as saying a few things about oil, but That I have said that I would be surprised if oil prices surpassed their 2018 high. That was $77 per barrel. Today we're at $81 per barrel, and we have gotten as high, I think, as $84 per barrel. So I've been wrong on that, and in assessing why we're wrong, it's becoming very clear it's not the demand side of the equation. It is the supply side. We have ESG, so environmental, social, and governance objectives that pension funds are striving to achieve. And as a result, many pension funds, endowments, foundations are telling oil companies, look, we're not going to be buying your stock anymore because you're not shifting your capital spending from fossil fuels to renewables. And so a lot of companies are shifting their capital spending away from fossil fuels to renewables. And therefore supplies are not growing as quickly as they were before. Okay, so those are some of the reasons inflation may not be transitory. It's getting into the wage structure. If productivity does not pick up enough, could become a problem. And oil and wheat, food and energy, two necessities are up there and could be a reason that striking workers are not settling here. So we're on watch for inflation. Crypto is in the inflation camp. If you think about Bitcoin as being a hedge against inflation, if that's how you're thinking about it, or NFTs being a hedge, collectible, a hedge against inflation. So that could be in the inflation camp, as could housing. But let's talk about both of those. These are real assets, yes, and they can be hedges against inflation. But the stock market and the bond market are also assets. And we've got all markets rallying. All markets are rallying. And could this mean, therefore, that velocity is going down, the velocity of money? What does that mean? Now, this is a little esoteric, so forgive me, but I think it's really important. If consumers are spending their money on assets instead of goods and services, then what's happening is all of the money printing that people think is going to cause permanent inflation in the price of goods and services, that is wrong, that it's actually moving into assets. So velocity involves GDP and money growth. GDP is the production of goods and services, not assets. So the velocity of money has been coming down because people have been saving and putting more money into assets. Is that what's going on here? Well, in the GDP report this week, I think it was, or maybe it was last week, real GDP growth was 2%, a huge disappointment. But what the headlines did not capture is if you looked into the guts of the GDP report, what you would have found was the only reason GDP grew was inventories. And everybody thinks we're terribly short of inventories. Real final sales, so this is taking out inflation, real final sales were slightly negative. Now, could it be, and I'm seeing this behavior on the part of millennials, could it be that they would prefer not to spend on goods and services, but to invest, especially in crypto and NFTs and stocks? So very interesting there.